You're starting to see this real tension between kind of founder entrepreneur and investors. Not everyone's on the same page as to where they're trying to drive these businesses. What's also not clear is whether a lot of those founder entrepreneurs want to ultimately be public and deal with the regulation, deal with public shareholders. And so at some point, you've got a real problem there around how do you ultimately get out of things that are that big without going public? So
there's this idea by a Columbia professor of blitzscaling, that some of these companies that were startups got too much money too quickly. Do you agree with that kind of criticism?
You can certainly see it in a handful of examples where there was a kind of big run for we got to get market share, we have to build brand, we have to do both those things very fast. And so what you saw was a lot of capital coming in very quickly to try to go scale very quickly.
So what's the potential consequence for that?
I think you're going to see a few things. I think you can definitely see valuations for some of those unicorns and some of the tech pieces coming down. And I think you're going to have to figure out with leadership, what is the exit channel?
Where are sort of the pockets that you're finding something?
I think we're at this interesting spot where you're kind of getting back to basics. It's not trying to find cheap companies. One, if they're cheap for a reason. They're probably badly broken or not a particularly good business. I think where we're seeing the best opportunities are kind of mid-price deals that you can actually make better. And so they're good businesses, they're not great businesses, but with private equity help and influence and bringing in some of those resources, you're trying to make them into great businesses.
But given how much competition there is, aren't you concerned that the entry prices are just too high to do much with?
No. And we're not concerned about that because I think the opportunity set is growing rapidly. What's interesting is if you look at the opportunity set of how many private companies there are globally, and you measure that against how many public companies there are globally, public companies are basically flatline. You're getting 2, 3, 4% kind of growth in the number of public companies around the world, and that's 0 in the US. The private companies are still growing at a huge rate of speed. And so while there's a lot of capital and there's lots of private equity managers, the opportunity set's actually growing faster than the capital raise.
So you talk with also a lot of pensions and other investors who need to put their money and get something more for it. Are you telling them to lower their returns expectations, even if they expect private equity to outperform here?
Yeah, I think, well, one, we don't have to tell them that. They've already lowered them.
Okay.
So I think there's a recognition.
But not to maybe where they need to be.
Maybe not. I think that's, I mean, when you go around the globe, and I think sort of our vantage point of clients truly all around the world, and we work with clients ranging from enormous sovereign wealth funds down to high net worth individuals and retail investors. So we're really sort of seeing the spectrum. What's interesting to me is that there's not a uniform perspective on what can I expect, what should I expect. In general, I think you're seeing investors kind of taking return expectations coming down. The challenge is where are they moving and where are they going to? This has been the big driver of why private equity capital is rising, because they are making a conscious decision to move out of listed equities, to move out of listed credits, and they are moving to the private markets. And they're doing that because on a short-term basis, 3 years, or a long-term basis, 15 years, the private markets has been a better place to be on a net basis.
What do you think is going to be the fastest growing asset class within private markets over the next decade?
I think it's going to be credit, because I think we'll shift from performing credit to non-performing credit. So I think as the markets begin to soften here and you start to see cracks, I do think that kind of private credits are going to grow enormously. We will likely be growing more around non-performing credit.
Okay, so when is that going to happen?
Well, look, I think the signs are starting to kind of flash. I don't think they're flashing red, they're flashing orange. I think we are getting closer, closer, closer. It's hard to ever expect to see a major downturn in an election cycle. Obviously, current administration will do everything they possibly can to kind of keep the economy going. I think we sort of need to get past the election and then sort of see what happens to see whether you start to see that market begin to fall apart.
Which sectors are most vulnerable when we do get that downturn?
Well, I think, you know, retail clearly has been a place where, depending on how tied you are to the consumer and what price point consumer you're sort of dealing with, you have seen that in downturns move pretty aggressively, pretty quickly. Who knows what kind of new regulatory environment we might be in? So will healthcare be impacted by new regulation? Will energy sectors be impacted by new regulation? Will financial services be impacted? I think that's what's sort of most in the danger spots. I think technology, particularly because most of private equity is dealing with very small technology, is probably in some of the safer places.